This podcast is provided for educational, informational, and entertainment purposes only, without any express or implied warranty of any kind, including warranties of accuracy, completeness, or fitness for any particular purpose. The information contained in or provided from or through this podcast is not intended to be and does not constitute as financial advice, investment advice, trading advice, or any other form of advice. The information in this podcast is general in nature and is not specific to you, the users, or anyone else. You should not make any decisions, be it financial, investment, trading, or otherwise, based on any of the information presented in this podcast without undertaking independent due diligence and consultation with a professional broker or financial advisory. You understand that you are using any and all information shared in this podcast at your own risk. You are solely liable for any losses that you may incur from investing, and in no event shall we be liable for any losses which may be incurred while investing.
Hi everyone, welcome back to ABCC's podcast. We have Ellen with us today here as well, and once again, I am Marcus. Today we also have another guest with us. Her name is Beanie.
Hello everyone, I'm Beanie. So nice to be here today.
Yeah, so Beanie is also one of our business development executive at ABCC. And Ellen, you want to say hi as well?
Hello everyone.
Yeah, so today's topic is going to be something that is very interesting and is very current in the crypto news right now. If any of you have been taking a look at what has happened in the news for crypto, you have realized that there is a particular saga going on, or if I can say incident going on, and that is with regards to Celsius. And today we're going to talk about Celsius and what happened. But before we do so, probably we need to have some kind of, background and some kind of information on Celsius first. So probably I can get Beanie to explain more on that.
All right. Let me give you a quick introduction of Celsius Network. Celsius Network, they were actually founded in year 2017 by two guys called Alex Mashinsky and Daniel Leon. They are a centralized platform that offers yields on many cryptocurrency, including Ethereum, Bitcoin, and many stablecoins. They aim to provide a fully community-oriented alternative to traditional financial institutions, and thus they successfully raised $50 million from their ICO in March 2018. As of February 2021, Celsius also acquired more than 400,000 of users and held more than $9 billion in community deposits. Celsius Network also have their own token, which is known as CER token. It's an ERC20 utility token that powers the entire Celsius Network ecosystem. Their users are actually incentivized to both use and hold the token. As of 14 June 2022, current coin market cap ranking for this token, CR token, is at about number 270 with their market cap around $77 million. So I think that they had almost like $12 billion in asset under management last month with more than 1.5 million users on their platform.
Yeah, thank you so much for the introduction on Celsius, Beanie. I think what we are trying to talk about today is also what are they exactly, other than just the metrics that Beanie has shared with us. In essence, Celsius is kind of like a custodial asset manager, if I can say. If I use an example like the traditional world of ETFs, you can say companies like Vanguard, Fidelity, they have a basket of stocks, and then they into a retail facing ETF. They wrap a basket of stocks into a retail facing ETF, and they take a fee for rendering this service to the investors. But Celsius is kind of like Vanguard, but for the decentralized finance opportunities wise. They provide regulated access to loans and yield and takes a fee for doing so. So all without actually exposing, the users to any kind of inconveniences, and also like an ETF provider, Celsius doesn't offer direct exposure to the underlying positions that they are in. And I can say in this case, what happened with Celsius actually lies probably two problems that I have seen. In fact, that I have actually researched on as well. A lot of people are talking about mainly just these two functions that had a huge issue. The first one is the promise of very high yields. So I think Celsius has been upholding yields of about 7% on their stable coins, if I'm not wrong, for one of the longest time already. And combine that with them using like a way of including different investors based on accredited investors wise, based on regulated on-ramp wise as well. This actually, these two functions actually pave the way for Celsius to, actually have a lot of inflows of monies like cryptocurrencies, if I can say, like Bitcoin, Ethereum, and stable coins. And actually that built a huge portfolio for Celsius. And if I can say, what they did was actually using all these cryptocurrencies for on-chain leveraging as well as for stake Ethereum, in short STETH. And yeah, I think these two parts can be discussed more by Alan.
Okay, so for like on-chain leverages, which is one of the what Celsius were doing in the back, is they try to provide a low rate borrowing for users, and they will use that as a leverage through provision known as like money market, like MakeItDown or AV. So that meaning like Celsius is taking your deposit or the user's deposit in assets like Bitcoin and depositing them to borrow the like decentralized stablecoin like DAI. So Maker is a collateralized lending protocol, meaning if you put in the $50 of volatile collateral, for example, ETH or RAP BTC, you were able to borrow the DAI stablecoin. And if the value of collateral falls below the liquidation threshold, the whole grid or the online system will automatically liquidate your position and repay the loan and prevent bad debt. So what happened was having a 9-figure loans on Maker was a bit troublesome, but normally shouldn't have a problem because it is a well-written website that a lot of crypto users use. But since Celsius lending collateral is falling in value.
Yeah, I think what happened was...
Okay. I think it was because it's falling value, they got liquidated, and then they couldn't pay back, right?
Yeah, I think it's all because of the collateral falling value due to the market wise, and then they had to actually liquidate the customers that were staking with them in Celsius to repay their own collateral.
It wasn't like that, right? It was they got liquidated, but they which was their client's money because they were doing leverage through borrowing. So when the price dropped,
the margin call.
So on the price drop, so in order they give 17%, right? Or 7% was because they would borrow DAI and then buy more ETH and then put it back in and then borrow more. And then this way they were able to provide a high yield for their customers. It's a bit like Anchor, right? You can borrow after you stake.
Yeah.
So you're getting like 50, 70, 50, 60, even 70% APY per year.
Yeah.
Like for the STE, what happened was because if you stick on Lido,
Yep.
they give you a token that represents the future ETH after the merge.
Yep.
So what happened is they give 4% on the merge ETH and on the
Yeah.
STE on Lido. And then I think it's also the same story, right? After you have the STE, you were able to collateralize the STE and borrow ETH again, and then
Yep.
went back in Lido to get more STE. So
I think you can do that
rather
on
than
curve,
the
I think.
full,
I think you can do the swap on curve as well.
yeah, you can do a swap on curve, yeah. So what happened was not just so on the service it offers 4%, but you were able to manage to like leverage it maybe 2 to 3 times.
Yep.
So in that way, you will have able to get 12% with the same amount of money. But of course, you were also facing a much higher liquidation risk when STE falls DPEG. Well, I won't say DPEG, but when STE price dropped way below ETH and they got liquidated.
It's actually kind of like a TPEG as well.
It is a representation of the future ETH, right?
Yeah.
So it's like it's more like an option. So I mean, at the end, you're able to get the ETH back after the merge, but the price can volatile. It's like the Binance, the BETH, right? The BETH,
Correct.
which is issued by Binance.
Actually, the thing is the merge is not even. Nobody really knows when the merge is gonna come, right? I think the last time I heard.
Last time I heard it, they always have been delayed a few times, right?
Yeah, they delayed it quite a number of times.
Yeah, but I think recently, like they had it on testnet, but there's still some problem. I think
Yeah.
a lot of the blocks didn't sync. So they say we'll push back to Q3 this year, but I doubt it.
I also
To
doubt
be
it.
honest,
I think if it comes in end of the year, it's already.
if we can
Already
see
a
end of
big
the year,
surprise.
it'll be pretty good.
Yeah.
I think for long-term ETH holder, it shouldn't be a problem, or even it could be a good chance to get a actual discount. Because end of the day, the STE should be able to get your 1-to-1 back.
Back to parity, yeah.
Yeah.
I feel so as well. Actually, it's so sense. Like a lot of people say, right? Like right now, there's a lot of fear in the market, but if you have a long-term view of it, actually, it's one of the best opportunities for you to buy as well. And yeah, it depends on what kind of investment mentality you have as well, I guess.
With that, we have come to an end of part 1, and next week we'll talk more on the impact caused to the market. So see you guys next week. Goodbye.